Good afternoon from Toronto. My name is Mike Winan, and I'll be the moderator for today's webinar. I'm a principal at CPA Canada in the Research Guidance and Support Group dedicated to helping Canadian practitioners to apply accounting standards for private enterprises and standards for assurance and related service engagements. I'm pleased to welcome you to the Practitioner's Pulse webinar. We have over 600 registrants for today's session. Should you have questions during the presentations, please submit them using the Ask a Question field at the right of your screen, and we will answer as many as possible during the Q&A segment at the end of the webinar. The PowerPoint slides, webinar evaluation are available under Resources located at the bottom of your screen. Please note that in order to qualify for your Statement of Completion for CPD, you must pass the quiz at the end of the webinar. The quiz will be available following the webcast by selecting the quiz icon at the bottom of your screen. After passing the quiz, select the certification icon to receive your Statement of Completion for CPD. You will be able to access and complete the quiz within the archived version of this event. The Practitioner's Pulse series of webinars features 4 short segments providing a roundup on hot topics affecting your practice. Each segment highlights and answers specific questions, provides tips and guidelines to dealing with the issues, and points to available resources. This is followed by a question period at the end of all the presentations. Today, our accounting segment will update on current ASPE projects, including the Redeemable preferred shares issued in a tax planning arrangement project. The Assurance segment will discuss the Canadian auditing standards developments, including the new and revised suite of auditor reporting standards, the new exposure draft on CAS 540, the re-exposure draft on reporting on compliance, and amendments to CAS 250. Our tax segment will include discussion of tax implications relating to property division on a relationship breakdown. And finally, our practice management segment will discuss the features of Knotia. On behalf of CPA Canada, it is my pleasure to introduce today's speakers. Alpa Patel, Senior Manager at PricewaterhouseCoopers, who will present the update for accounting. Ismail Adekar, Senior Manager at Grant Thornton, who will present the update for assurance. Hugh Nielsen, Director of Tax Services at Kingston Ross Pasnick, who will present the update for tax. And Paul Kneebone, Sales Rep for CPA Canada, who will present the practice management segment. Please join me in welcoming Alpa Patel. Alpa is a Senior Manager in the Private Company Services Group at PricewaterhouseCoopers. She provides assurance, technical, and tax advice to clients and engagement teams, and also aids teams with the technical application of accounting principles for private company clients. Alpa currently serves as a member of the Accounting Standards Board's Private Enterprise Advisory Committee. Good afternoon, Alpa.
Good afternoon, Mike. Today we'll outline which projects the Accounting Standards Board is currently working on, as well as projects which the Standing Board has recently completed. Oh, let me just fix the slide. There we go. Projects currently in progress include agriculture, redeemable preferred shares issued in a tax planning arrangement, and the 2017 annual improvements to ASPE. We've included the links to each of the project pages. Please refer to these pages for further updates on these projects. Additionally, in January, the Standards Board approved a project to address several narrow scope issues identified during the post-implementation review of Section 3856 financial instruments, associated with the scope of related party transactions and measurement of related party compound financial instruments and disclosures. We are planning on addressing this project in our Fall Practitioner's Pulse webinar. So for the redeemable preferred shares issued in a tax planning arrangement project, and like Mike said, I think this one is definitely a hot topic right now. There's been extensive deliberations, and the Standards Board has carefully considered the feedback that is received from stakeholders during its consultation and outreach activities. The Standards Board reaffirmed its position that these shares meet the definition of a liability, but considered alternatives to the manner in which the classification exception is described. First step was to conduct further research with tax and assurance practitioners into the characteristics of arrangements to identify alternative approaches. Next step was to conduct field testing with large and small practitioners, considering examples of actual tax planning arrangements seen in practice to assess the viability of an alternative approach. Based on the additional research and the field testing done, a viable alternative approach for the classification exception was decided on the basis of multiple conditions being met. The first condition is retention of control of an enterprise. Secondly, the control must be retained by the party receiving the redeemable preferred shares. The Standards Board further decided on the additional conditions necessary to qualify for equity classification, which determined that control of the future cash outflows of the enterprise has not changed. Therefore, the individual or individuals who control the cash flows prior to the issuance of the redeemable preferred shares would also control the cash flows subsequent to the issuance of the redeemable preferred shares. The Board also decided that additional guidance relating to substantive rights should be added into Section 1591 subsidiaries to provide sufficiently robust guidance to address the characteristics of the redeemable preferred shares issued in a tax planning arrangement. The Accounting Standards Board considered the advice of its private enterprise committee on the effect of the proposals on current practice as a basis for the exception will result in some transactions that qualify today not qualifying going forward. The Board is deliberating transition considerations, reclassification, and disclosure requirements. The Board continued its discussion on transitional provisions and began its discussion on disclosure requirements at its May 2017 meeting. The re-exposure draft is expected in late Q3 of 2017. Our next topic is the narrow scope amendments to financial instruments. The Accounting Standards Board carefully considered the feedback it has received from stakeholders in the Section 3856 post-implementation review. The Board was made aware of multiple concerns such as the diversity in accounting for related party financial instruments and the usefulness of some financial statement disclosures. The Accounting Standards Board is considering amendments to address the scope of accounting for related party financial instruments after initial recognition, the measurement of related party compound financial instruments, and the financial instrument risk disclosure requirements. An exposure draft is expected on these in Q4 of 2017. The Board also heard feedback from stakeholders on other challenges, such as fair value measurement, hedge accounting, and derecognition and classification of equity and financial liabilities. The Board is considering these topics in the context of its consultations on relative priorities for Part 2. So research activities on topics identified by stakeholders through the Board's strategic planning process, the review of changes in other standards, U.S. GAAP, IFRS for small, medium-sized entities, and their ongoing consultation with stakeholders, including PX, have identified topics of priority. These are revenue, related party transactions, financial statement concepts, and other specific topics including the benefit of amortizing goodwill and providing relief from the recognition of intangible assets on a business combination, and clarifying the definition of a business to help distinguish between the acquisition of a business and a group of assets. We will delve into these topics in the next few slides. The Board will be conducting a survey of stakeholders to prioritize these topics for its long-term agenda as current projects are completed. The survey will be available in June 2017, so please keep an eye out and respond. The revenue standards for U.S. GAAP and IFRS are changing, and the Board is researching the need for more guidance in Section 3400. The Board is exploring the relevance of guidance in IFRS and U.S. GAAP for Part 2 stakeholders for areas such as non-refundable fees, multiple element arrangements, percentage of completion, loyalty programs, and other complex arrangements. Data indicates that 40 to 50% of not-for-profit organizations using Part 3 generate revenue through sale of goods and services and apply Section 3400. The Board recently performed a revenue survey and will communicate the results when the results are available. Section 3840 related party transactions, another hot topic area, I guess, have some issues being addressed in the post-implementation review, as we discussed earlier. As well, the board is considering it as another area of priority. The board is researching other areas for improvements in this section, including measurement of related party financial instruments and business combinations under common control. The board has been using the data from the CRA, which indicates the size and volume of related party transactions. Section 1000, financial statement concepts, is another area the board's looking at. Standard setters are deliberating changes to or have already amended their financial statement concepts. The board is researching the need to revise sections of this standard. Changes to the financial statement concepts will impact both Part 2 and Part 3 stakeholders. The board is considering both sets of stakeholders for these changes. Other topics added to consultation on relative parties in Part 2 after review of amendments to IFRS, IFRS for SMEs, and U.S. GAAP include the benefit of amortizing goodwill and providing relief from the recognition of intangible assets on business combinations, and clarifying the definition of a business to help distinguish between the acquisition of a business and a group of assets. The board is also planning to consult with stakeholders as part of its annual plan to determine if and when to undertake post-implementation reviews for Section 1582 business combinations and Section 3462 employee future benefits.
Okay, thank you, Alpa. That's it for our accounting section today. It was shorter than usual on this webinar. This resources slide contains the links to the Accounting Standards Board's project pages that Alpa referenced throughout the presentation. And we've also included a link to the Guide to ASPE, which is a comprehensive resource for practitioners and those who prepare financial statements in accordance with ASPE. Using illustrative examples, charts, and diagrams, the guide contains 46 chapters covering the applications of standards on a wide range of financial reporting areas. Before we get into the assurance section, I just wanted to mention that CPA Canada has developed a landing page for all of its publications related to the new and revised auditor reporting standards. The URL for the landing page is cpacanada.ca/auditor reporting. The alerts mentioned in this presentation will be located on this page. Currently, only one of the alerts is live. However, the other alerts will be up on the page within the next week or so. And if you click on the links on these slides, it will take you to the landing page. I recommend bookmarking it in the future, as we'll be updating it as we release new publications, and we'll also be adding helpful external resources to the page as well. Please join me now in welcoming Ismail Akader. Ismail is a member of the National Assurance Standards Group at Grant Thornton. In his role, he assists engagement teams in resolving complex assurance-related issues. He also develops training and writes communications dealing with the emerging assurance issues.
Hi, Mike. Thank you for that introduction. Today, I'll discuss a few new assurance updates, including the new suite of auditor reporting standards, the exposure draft for CAS 540, auditing accounting estimates, and the amendments to CAS 250, responding to non-compliance with laws and regulations. As we only have a short segment, we'll discuss what the new and revised standards become effective and a few of the key changes, which are by no means meant to be a comprehensive discussion of these new and revised standards. The full list of new and amended CASs is provided in the CPA Canada Audit and Assurance Alert titled New and Revised Auditor Reporting Standards, which is provided in the resources sections of the webinar. It is important that practitioners read the entire text of these standards, including their application and other explanatory material, to understand their objectives and apply the requirements properly. This alert also contains an example illustration of an independent auditor's report under the new standards. Just making sure. Okay. CPA Canada has published 3 additional audit and assurance alerts on these new and revised standards, one specifically on key audit matters, one on CAS 720, other information, and another that is an FAQ for management and audit committees. Now, the FAQ would be an ideal document to provide to your clients and audit committees to give them the information they need to know about the new auditor reporting standards. All right, so the new auditor reporting standards are a collection of changes to various standards in the CPA Canada Assurance Handbook that result in a new and enhanced independent auditor's report. The new report provides reporting of going concern matters, as well as entity-specific reporting of other information and key audit matters for certain entities. The report also provides enhanced transparency by clarifying the scope of the auditor's work, a new explicit statement of the auditor's independence and fulfillment of ethical responsibilities, as well as new descriptions of the roles and responsibilities of the auditor, management, and those charged with governance. These changes aim to enhance communication by offering entity-specific information to make the auditor's report more informative and relevant to financial statement user decision-making. The new and revised auditor reporting standards and related conforming amendments are effective for audits of financial statements for periods ending on or after December 15, 2018. They were approved by the ASPE in April 2017 and published in the Handbook as of yesterday. So they are currently available on Knotia. And of course, earlier application is permitted. So CAS 570 has been revised with the objective to enhance the communications about going concern matters in the auditor's report. The most significant change is there is now a requirement for a separate section under the heading Material Uncertainty Related to Going Concern, when a material uncertainty exists related to an entity's ability to continue as a going concern and is adequately disclosed in the financial statements. The section will include a reference to the note in the financial statements that describes the material uncertainty and a statement that these events or conditions indicate that a material uncertainty exists that may cast significant doubt on the entity's ability to continue as a going concern, and that the auditor's opinion is not modified in respect of the matter. There is also a new description of management's responsibility for assessing the entity's ability to continue as a going concern and whether the use of the going concern basis of accounting is appropriate, as well as disclosing, if applicable, matters relating to going concern. The explanation of management's responsibility for this assessment includes a description of when the use of the going concern basis of accounting is appropriate. The final reporting requirement change is there is now a new statement that the auditor's responsibilities are to conclude on the appropriateness of management's use of the going concern basis of accounting, and based on the audit evidence obtained, whether a material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. In addition to all these disclosure changes, there is also new performance requirement that requires auditors to evaluate the adequacy of management's disclosure in the financial statements for close calls related to going concern. So, for example, when events or conditions were identified that may cast significant doubt of an entity's ability to continue as a going concern, but due to management's plans, the auditor concluded that no material uncertainty exists. CAS 720 has been revised and now clarifies the external auditor's responsibilities with respect to other information released by an entity. So other information is financial or non-financial information included in an entity's annual report. An entity's annual report may be a single document or a combination of documents that serve the same purpose. So some common examples include the management's discussion and analysis, the MD&A issued by reporting assurers, management report of fund performance issued by investment funds under the provisions of Canadian securities legislation, financial statement discussion and analysis or equivalent documents issued by public sector entities, and an annual report issued by an entity listed or other than listed. Now, the objectives of CAS 720 are to consider whether a material inconsistency exists between the other information and the financial statements, and if so, to respond appropriately. There is a new section in the report under the heading Other Information when an entity prepares other information containing or accompanying the entity's financial statements and auditor's report thereon to explain management's and the auditor's responsibilities for the other information and the auditor's conclusion from reading and considering the other information about whether it is materially inconsistent with the financial statements or our knowledge obtained in the audit or otherwise appears to be materially misstated. For an audit of a non-listed entity, this section will be added when, at the date of the audit report, the auditor has obtained some or all of the other information, whereas for an audit of a listed entity, This section will be added when, at the date of the audit report, the auditor has obtained or expects to obtain the other information. For more information, the revised CAS 720 includes illustrative examples, and you can see CPA Canada's Audit and Assurance Alert for further details. Key audit matters. These are the matters that, in the auditor's professional judgment, were of most significance in the audit of the entity's financial statements of the current period. As we call them CAM, they are selected from matters communicated with those charged with governance and placed in a separate section of the auditor's report. The auditor's determination of CAM is limited to those matters of most significance in the audit of the financial statements of the current period, even when the auditor's opinion refers to each period for which financial statements are presented. The AASB has decided that key audit matters will not be a requirement unless law or regulation requires the auditor to communicate it, or when the auditor chooses to communicate CAM. If CAS 701 is applied, then the auditor would add a separate section in the auditor's report under the heading Key Audit Matters. CPA Canada has published an Audit and Assurance Alert on key audit matters that is included in the resources section of this webinar. The alert goes into depth on how CAMs are to be determined and also how they are communicated in the auditor's report, including an illustrative example. Other significant changes to the auditor's report include the auditor's opinion section has been moved from the end of the report to the very beginning. The basis of opinion section will follow the auditor's opinion and now includes a new explicit statement about the auditor's independence in accordance with relevant ethical requirement and the auditor's fulfillment of other responsibilities, an identification of those charged with governance when applicable, and their responsibility for the oversight of the financial reporting process, an enhanced description of the auditor's responsibilities. So in particular, new descriptions related to the auditor's responsibilities in an audit of a group financial statements and regarding communications with those charged with governance. Now for listed entities, there are separate requirements, a new description of the auditor's responsibilities to provide a statement to those charged with governance that the auditor has complied with relevant ethical requirements regarding independence, and a new disclosure of the name of the engagement partner. So for more details, the new auditor reporting standards, including full illustrative reports, please see the 4 CPA Canada alerts linked in the resources section. Now, although our assurance segment focuses on the new auditor reporting standards today, we wanted to briefly highlight a very important standard and related exposure draft issuance that we would like to draw practitioners' attention to. In May 2017, the AASB issued an exposure draft on proposed changes to CAS 540, based on the exposure draft recently issued by the IAASB. The exposure draft highlights significant changes impacting the audit of all accounting estimates. It is important for practitioners to read the exposure draft to familiarize themselves with the proposed changes and to provide feedback on the practical implications of these changes. Canadian practitioners through the AASB have an ability to influence the development of the international standards on auditing, so the standard is clear, understandable, and can be practically applied to Canada. The AASB will be submitting a response to the IAASB's exposure draft, taking into account comments received from Canadian practitioners. Now, the deadline for providing feedback is July 7, 2017, and the exposure draft can be found at the link on the slide. AASB staff hosted a webinar the last week of May in both English and French. These were facilitated by a member of the Auditing Accounting Estimates Advisory Group and an AASB member, respectively. The webinar provides background on the exposure draft and reviews key elements of the proposals. If you did not attend, we encourage that you play back that webinar in order to review the highlights of the proposed changes and to start thinking about how they may affect you. It may help give you some context before you read the exposure draft in full. In place of face-to-face meetings across the country, the AASB staff will host at least 4 video conference sessions to discuss the proposals and give the opportunity for you to provide your input on the questions in the exposure draft. We encourage you to sign up to the date and time that suits your schedule, and you will hear more from the AASB and your provincial bodies when the dates are available. Lastly, for more information on this topic, we have included a link to an Audit and Assurance Alert recently published by CPA Canada's Research, Guidance, and Support Group. Once again, the deadline for providing feedback is July 7th, 2017. All right, so on April 19th, 2017, the board issued a re-exposure draft of 2 proposed new standards that would replace existing sections dealing with special reports on an entity's compliance with agreements, statutes, and regulations. Stakeholders are encouraged to submit their comments by July 28, 2017. The board proposes, subject to comments received following re-exposure, to issue Canadian Standards on Assurance Engagements 3530, which is special considerations of attestation engagements to report on compliance, and CSAE 3531, which is direct engagements to report on compliance. Now, these standards would replace Section 5800, which is special reports introduction, Section 5815, which is auditor's report on compliance with agreements, statutes, and regulations, and Section 8600, which is reviews of compliance with agreements and regulations. The standards would also replace auditing for compliance with legislative and related authorities in the public sector, paragraphs 5300, 11 to 13, addressing engagements that require an auditor, depending on the audit mandate, to express an opinion on whether an entity complied with specific authorities or whether its transactions were carried out in compliance with specified authorities. Webinars are planned for June 21st in French and July 5th in English. There are also video consultations planned, and you can check on the ASPE website for further details. Our last topic for today is the recent revisions to CAS 250, which is considerations of laws and regulations in an audit of financial statements. The revised standard was published into the Handbook in March 2017. A little bit of background on the project. The revisions to ISA 250 were made in response to changes in IESBA, which is International Ethics Standards Board for Accountants, made to their Code of Ethics for Professional Accountants. The revised IESBA code sets out a framework for the response of professional accountants to identified or suspected non-compliance with laws and regulation, or no-clear as we call it, including whether identified or suspected no-clear should be disclosed to the appropriate authority. While the IESBA code has not been adopted in Canada, the provincial rules of professional conduct must be as stringent unless there is a legal, regulatory, or public interest reason. Now, the CPA Professions Public Trust Committee is currently considering the no-clear changes to the IESBA code in relation to the CPA Professions' existing ethical standards and within the context of Canadian laws, regulations, and the public interest. Now, notwithstanding this ongoing review, the IESBA code amendments to ISA 250 allows for flexibility when ethical codes other than the IESBA code are applied. The revisions to CAS 250 alert the Canadian auditor or practitioner to the additional responsibilities that may exist under the rules of professional conduct in Canada. During the course of providing professional services to an entity, the auditor may become aware of an act or suspected act of no-clear committed or about to be committed by the entity, those charged with governance, management, or other individuals working for or under the direction of the entity. CAS 250 deals with the auditor's responsibility to consider laws and regulations in an audit of financial statements. If the auditor becomes aware or suspects no-clear, CAS 250 explains the audit procedures required to be performed. For more information, the revised CAS 250, please see CPA Canada's Audit and Assurance Alert for further details. For more information, the resources here include CPA Canada's publications discussed throughout the presentation.
Thank you, Ismail. Just to clarify, the top 4 links on this slide will take you to the CPA Canada landing page for the new and revised auditor reporting standards. And currently only the top link, the alert on new and revised auditor reporting standards, is live. The other 3 alerts, the key audit matters alert, the other information alert, and the FAQ for management and audit committees will be live within the next week or so. I'm now pleased to present our next speaker for the tax segment, Hugh Nielsen. Hugh is an independent contractor to Kingston Ross Pasnick LLP, where he is a director of taxation services, and to Video News Inc., where he is a member of the editorial board for Video Tax News. He has over 25 years of public practice experience, focusing on income tax services for individuals and owner-managed private corporations. Today, he is going to speak about tax issues for personal tax filings in a relationship breakdown.
Thanks, Michael. See if we can get these slides working. Now, in our March Practitioner's Pulse, we discussed some issues which arise when a client gets divorced. The breakdown of a relationship creates enough personal upheaval that it's patently unreasonable to throw in the myriad legal and tax implications that also result. Unfortunately, we don't have any options in this regard, and as professional advisors to the parties, we must advise them as best we can so they can continue with their separate lives. The tax provisions applicable to matrimonial breakup are numerous and complex, and most practitioners come into contact with them only on rare occasions. Family law lawyers and even judges vary widely in their knowledge and understanding of these provisions. Add in the likely animosity between the two parties to any agreement, and you have a recipe for a very unpleasant and difficult professional engagement. We can coordinate the slides. There we go. I'm better at tax than tech. Generally, there are three broad areas we have to consider: taxation and deductibility of support payments, tax credits and benefits for children, and tax issues arising on the division of property of the marriage. Each of these has significant challenges and complexities from a tax perspective. Our March session focused on support payments and claims for children. This session will expand our discussion into tax issues related to property division. As a reminder, a married relationship can have three phases: married, separated, and divorced, while a common law relationship really only has two: common law partners or not common law partners. As well, the termination of a marriage requires that the parties obtain a decree nisi. However, for income tax purposes, the termination of a common law relationship only requires they cease to cohabitate in a conjugal relationship for a continued period of 90 days. Consequently, a common law relationship ceases and the tax rules apply or cease to apply much more quickly than with a formal marriage. As well, the date of change is largely outside of the control of the parties and advisors. The definition of common law partnerships and even the terms used varies between provinces and seldom matches the income tax definition. Where capital property is transferred to a spouse or a former spouse in settlement of rights arising under the marriage, the property is transferred at cost for income tax purposes. This provision also applies during the marriage. However, due to the attribution rules, such transfers are not often encountered in tax planning outside a relationship breakdown. This allows assets to transfer with no immediate recognition of any inherent gains or losses. The parties should consider the tax cost which is being assumed by the new owner of the property in determining the asset division. Alternatively, an election can be filed to opt out of this rollover, instead deeming the property disposed of and acquired for its fair market value, or FMV. While we're often focused on deferring taxes, there are situations where this rollover may be undesirable. Where assets roll over, the recipient spouse will need to obtain historical cost records from the transferor spouse. If those records are not accurate or not complete, any risk rests with the new owner of the property. If further information is needed when the assets are sold, obtaining this from the former spouse can prove difficult. Electing out of the rollover means the spouses receive the asset at a new cost set at today's date. Perhaps the asset is eligible for the capital gains deduction. If the transferor spouse will never likely have assets on which the capital gains deduction can be claimed in the future, realizing tax-free gains to step up the tax cost may be desirable. The transferor spouse could also use capital losses of other years to offset the gains, although these could be used against any capital gains, so that may not be as desirable. Perhaps the asset has declined in value and the transferor wishes to realize the loss. Here, a careful review of the stop-loss rules applicable to affiliated parties should be undertaken. However, as affiliated status ends when the marriage does, it may be possible to realize losses in the course of division of matrimonial property. Finally, perhaps the transferor has limited income and could realize gains at a relatively low tax rate. It bears noting that the election means the asset is transferred at fair market value. The parties cannot select a transfer value between cost and FMV. However, each asset can be elected on. This can be helpful in transferring shares. For example, assume Mr. A is transferring 100 common shares of the private corporation which owns Mrs. A's business. The The shares qualify for the capital gains deduction, but they have a nominal income tax cost and a fair market value of $3 million. Mr. A could elect on, say, 25 of the shares to realize a $750,000 capital gain, letting the remaining 75 shares transfer at their nominal cost. Having made the election, the parties are at risk if CRA were to challenge the value they estimated. Suppose, for example, that Mr. A's shares turn out to be worth $4 million. The election now means he's realized a capital gain of $1 million, not all of which can be offset by his capital gains deduction. A proper valuation, or perhaps a restructuring to provide shares whose value is more certain, similar to estate freeze shares, could be considered. The transferor of the property must elect out of the rollover in their tax return for the year of transfer. The recipient may wish to obtain evidence that this election was filed to ensure he or she does not take over an unexpected tax liability. Where a couple owns two properties, each of which could be considered a principal residence, for example, a house and a summer cottage, the designation of the principal residence for the years of marriage will need to be determined. Assuming one spouse takes the house and the other receives the cottage, they will not be able to fully exempt gains on each property from taxation. Consequently, as part of the matrimonial settlement, the parties should agree on how the PRE will be divided. This may be another reason to elect out of the rollover between spouses. A possibility which is much easier to overlook arises where one party retains the family residence and the other acquires a new home during their period of separation. Both spouses or common law partners must designate the same property for all years during which the relationship exists, except for years throughout which they live apart and are separated under a judicial separation or a written separation agreement. It's not uncommon for parties to live apart for several years during which there is no written separation agreement. Where a second residence is acquired by one party during that period, the issue of which property will be designated the party's principal residence can become significant. As an example, consider Mr. and Mrs. X. They married in 1999 and acquired a residence in that year. In 2008, they separated, and Mrs. X moved out of the matrimonial home. In 2009, she acquired a residence for her own occupations. The parties never had a written separation agreement, and they're divorced in 2017. From 1999 to 2008, there's only one residence, so there's no issue of which property will be designated for those years. As they will not be married throughout or after 2017, they'll each be entitled to independently designate a property as their principal residence for those years. However, only one property can be designated for the years 2009 through 2016. One of the parties will not be able to fully exempt their residence from tax. Finally, with the new disclosure requirements for real estate dispositions, it would be prudent to ensure these appear on the transferor spouse's return. Of course, if the property rolls at cost, the transferor may not be concerned about never becoming statute barred in respect of that particular disposition. Assets transferred between spouses commonly attract attribution of income and or capital gains back to the spouse who originally paid for the property. Attribution of income ends on separation, while attribution of capital gains ends on divorce. An election can be filed during separation to end the attribution of capital gains as well. This election must be jointly signed and is filed with the return of the individual who would otherwise have been required to report the gain or loss on that property. That would normally be the original owner, not the spouse who received and sold the property. The attribution of withdrawals from spousal RSPs also ends as a consequence of separation. While most assets can be transferred with no tax costs, some assets cannot be transferred without realizing tax implications. There is no rollover for inventory. This would include what we typically think of as inventory in a business. However, the business owner typically retains these assets. It also includes farm inventory, such as livestock, creating extra issues for divorcing farmers. The parties may also own land which was acquired for resale or development. Land acquired on speculation, intended for resale when the municipality expands or when the property is rezoned, tend to be especially easy to overlook. If one spouse is a non-resident of Canada, no rollover of capital assets will be available. Where one party is planning to cease Canadian residency, this can also impact planning due to the deemed dispositions of assets on cessation of residency. The transferor spouse will also need to consider any relevant withholding or disclosure requirements. As is always the case, adding international issues complicates tax matters very rapidly. The valuation of pension plans can be tricky at best and subject to many assumptions which affect the value of the plan. This is well beyond the scope of a tax discussion, other than to note that commuted value is almost always wrong for defined benefit plans. Depending on the terms of the pension plan, it may be possible to have pension payments split between the parties. That removes any risk of the payer defaulting. It may eliminate some valuation issues if each spouse receives a portion of the pension. However, it does not eliminate the need to determine what portion of the plan will go to which party, nor the impact of future years of employment. Additionally, it tends to maintain a relationship between the parties, as there is no money available until the pensioner decides to start collecting. As well, what happens if the pensioner dies before retiring and the pension never pays out? What if the pensioner chooses options such as guarantee periods, coordination with CPP or OAS that the former spouse disagrees with? These situations may result in issues being reopened decades in the future, especially if one party fails to honor the original agreement. Where the plan does not allow for a split at source, an agreement that the payer will remit X% of the pension as and when received to the recipient as his or her share of the pension will often be accepted by CRA, thus allowing both parties to report their share of the payment as pension income on their respective personal income tax returns and to claim the pension income credit. Due to the matching program, reporting this may be challenging or frustrating for the party who receives the T4A slip. The pensioner could report the full amount and deduct the other spouse's share on line 232, other deductions. Although this avoids the matching problem, CRA often requests support for such deductions. While not common, if the pension plan allows it, it is possible to transfer some or all of the pension plan on a tax-deferred basis to one spouse or former spouse, similar to other tax-deferred plans. The Canada Pension Plan Act provides that one party of a divorced or separated couple may unilaterally apply for a split of their CPP credits. If this occurs, the credit built up by the two parties during each year of marriage are combined, then split equally. In most provinces, an agreement between the parties will not prevent this split. Only Quebec, Saskatchewan, Alberta, and British Columbia have legislation to prevent a split in contravention with such an agreement. Most tax-advantaged investment vehicles, including RRSPs, TFSAs, and RIFs, can be transferred between the respective spouses and former spouses' registered accounts. The plan issuers are generally familiar with the documentation required. What about the family corporation? This can add huge amounts of complexity to matrimonial property division. When the parties separate, historical wage payments may need to be revisited. Are both spouses still working in the business? Reasonableness of salaries needs to be considered. It would be much lower risk for the owner-manager to take a higher salary and pay support to the separated spouse who's no longer working in the business. This also avoids CPP contributions for the spouse who's left the business. If the spouse leaving the business has worked there since 1995 or earlier, there may be scope to pay a retiring allowance, which can be transferred to the departing employee's RRSP. A problem that occasionally arises in the corporate situation is the surprise T4 or T5. These are often received well after the fact, possibly even after settlement agreements have been finalized. Sometimes the first the recipient knows about this income is when CRA reassesses to include the amount in their income. Interest is charged and sometimes penalties. Needless to say, these result in accounting and legal costs disputing with CRA and the other party. Identifying all income which will arise, including that required to clear any shareholder drawings, should be a focus up front to ensure any need for T4A or T5 slips or any other income, any tax withheld, and the responsibility for the resulting personal taxes is well understood. Existing family strategies will need to be reviewed. Are they still suitable after divorce? Can they be used to fund matrimonial liabilities in a more tax-effective manner? Does the divorce place the plans at risk? One of CRA's most common source of tips is disgruntled ex-spouses. Hopefully, both spouses understand that a CRA assessment of either party serves only to deplete the resources available to the family as a whole, regardless of whether the audit actually discovers any additional taxes payable. The wise professional may wish to remind them of this fact. If there are potentially contentious tax issues in the family history, An agreement that any reassessments and cost of addressing CRA inquiries will be shared may be prudent for the protection of the party who would otherwise bear the brunt of these costs. Existing planning structures need to be reevaluated in light of the split, preferably in a manner that maximizes their ongoing benefits and doesn't place the historical savings at risk. Consider the case where one spouse has sworn on affidavit that the direction of income to children of the marriage through a family trust was, and I'll quote, never intended to transfer any value to the children. It was just a tax scam. Clearly, this is not the kind of statement one wants in the public record. The family trust might possibly have been able to permit the funding of child support obligations in a more tax-effective manner, depending on its structure, by delivering income directly to the children. Even fairly standard tax planning can appear very negative. There's also a risk of more aggressive filing positions coming to light. As an example, aggressive remuneration of family members may be challenged in the course of child support income determination or evaluation of the business. Has the departure of the spouse who was earning $75,000 annually for valuable services to the company had an impact on current corporate operations? Does the former spouse of a shareholder suggest that certain expenses of the corporation are really perks for the shareholders rather than legitimate business costs? It's not uncommon, especially when the family's wealth is tied up in a large illiquid asset like a pension or a family business, for one spouse to go into debt to discharge their obligation to divide property. Interest to fund a property settlement is not incurred to earn income and would therefore generally be non-deductible. The Income Tax Act does not similarly differentiate in respect of interest received. If one spouse pays the other's property entitlement over time with interest, the recipient will certainly be taxable, regardless of whether the payer gets to deduct that interest. The assets of the parties should be reviewed to assess whether there is a way in which such interest could be deductible. Perhaps rather than a transfer of assets under matrimonial property accompanied by a lump sum settlement, one spouse can purchase assets from the other, borrowing the funds to do so. If the underlying assets generate income, the payer at least now has a case for deducting interest costs. As always, careful planning is required to minimize the risk of challenge of the income tax results. Ideally, this would all be undertaken prior to divorce. Assets transferred between married persons, even if separated, transfer at income tax cost, absent elections to the contrary. Assets transferred between former spouses must be transferred as part of a settlement of matrimonial property to enjoy that rollover status. Some assets, however, may be conducive to transfer at fair value. Perhaps the shares of the family business or farm property gains would be eligible for the capital gains exemption. Alternatively, they may have assets with limited or no gains to be realized, such as shareholder loans in a family company. Whenever a transfer occurs at fair value, however, the risk of CRA challenge to the value should be considered. Of course, this strategy requires the spouse to receive a cash settlement, own assets to sell to the other spouse. A more aggressive approach would be to transfer those assets to the spouse as part of the settlement of matrimonial property, then purchase them back in a separate transaction. Care should be taken to ensure all required steps are taken to avoid attribution of any resulting gains. It seems more likely CRA would challenge this approach than the acquisition of assets held by the other spouse for many years. This presentation only summarizes more common issues arising in a relationship breakdown. Given the complexities and the unlikeliness that any settlement will easily be varied after the fact, expert advice is critical. This is especially true where there are additional complexities like a non-resident, death of one of the parties, or that family corporation to consider. Finally, in extending well beyond tax issues, the accountant is often a trusted family advisor. The practitioner should be very cautious of being dragged into a situation where he or she may later be accused of a conflict of interest. Clearly, the parties will no longer be acting in concert when they're negotiating a divorce. Complex tax and valuation issues frequently arise in divorce matters. Difficult though it can be to tell the client that their trusted accountant is not expert in every possible financial area, bringing in actuaries, appraisers, business valuators, and tax specialists is often essential. Obtaining the assistance of a practitioner with experience and expertise in this complex area, or simply one who brings no pre-existing relationships to the table, can be very valuable.
Thank you, Hugh, for the very informative presentation. For today's last segment, please join me now in welcoming Paul Kneebone. Paul is a member of the publishing and sales marketing team at CPA Canada. He's been a long-time sales consultant with CPA Canada in the member development and support group, and he supports most of Ontario, Manitoba, and Saskatchewan, and is responsible for all academic accounts. He also supports provincial CPA practice inspectors and advisors. He frequently does group and individual Knotia demo sessions.
Thanks, Mike. Thank you for that introduction. Today I'll give you an overview of the Knotia platform and discuss some of the features and tools, including the recent new Knotia functionality upgrade. Not trying to do an expert presentation here in terms of every nuance of Knotia, but hopefully I'll give you a bit of background. I've been around since 1998, and everybody always asks the question, what the heck is Knotia? And it's a made-up word. Even then I was told it was simply a type of a knowledge expression, so it's got no etymology basis or anything like that. It is what it is in terms of that. Knotia is free, as you know, for every CPA member. All they have to do is activate their own Knotia profile. I'm still surprised how many members haven't done that, so I remind you for yourself and your colleagues, wherever you are, to make sure that they are, because there's much more now than simply the handbook. The official name of it, of course, is CPA Standards and Guidance Collection, the full handbook. But there's also two other key pieces that are available. BAR, as we commonly call it, everything has to have an acronym these days. Business and Accounting Resources, which has always got new material. And the CPA Magazine is now available as well. Sorry, just catching up the slides here if I could. Just take me a minute on that score. So once you log on to Knotia with your email address and password, this is your home screen. And I always recommend people check out a few other things they may not be aware of. There's some quick links and other resources on the left panel. You got a list of your current subscriptions, whether they're complimentary or paid. And there's a What's New on the right panel. There's a number of drop-downs on the green toolbar. You've got Home, Subscriptions, Briefcase, and Session Tracker. Briefcase, just for those that aren't familiar with it, is basically what I call an online electronic filing cabinet. You can have literally thousands of folders in there. So if you do search results and you want to save them for next time, you can put them anywhere there. It's up to you to call it what you like, and you can share it with different levels of security with everybody of your firm if you so choose. Also, there's something called Session Tracker if you want to, from the point of view of tracking your time for billables. There's a Session Tracker you can turn on. There's, again, the main toolbar. You can choose whether English or French for an interface. You can search all. This is kind of handy, whether you're doing tax and you want to do income tax and GST at the same time, or maybe you're in accounting and you want to do the professional engagement manual and the quality assurance search at the same time. You can click on that button, and what will happen is you can checkbox the products that you want. There's a print icon. I always recommend you use that and don't use the one that's simply in your Google or whatever interface that you have, because things will run off the screen. And finally, the one I want to highlight in particular is called Help, and it's got a number of support options for you, which include a number of things. I just want to spend half a minute here describing those. You've got something called Knotia Quick Reference Guide and the Knotia Quick Reference Card, both of which are printable PDF files. And there's something called the Knotia Search Syntax Card. I recommend you particularly print that one. It gives you a number of shortcuts. And then finally, two other things. There's a call-in number, a toll-free number, which you can call anytime during normal business hours, Eastern Standard Time, and get help in person from a Knotia support individual. And then there's a whole series of how-to videos. They're very short, and they'll cover things that I don't have time to get into detail today on. And again, in the process, guess what? You can get a few PD points, so that's all right as well. Just want to highlight a couple things as we go through here in terms of the CPA Standards and Guidance Collection. Here's where you find your handbook. It's listed alphabetical, and it always says member after it, so you know exactly where it is. In terms of what's in the handbook, I think we're pretty familiar with it, but just a quick refresher. You've got Accounting's Part 1 through 5. 5, of course, is the pre-changeover, the old standards. The Assurance, which we'll get to in a moment. And the one I'll spend just a moment on a little later on after Public Sector Accounting is something called Risk, Oversight, and Governance, which includes 4 key modules that basically people aren't that aware of. Again, just as a highlight on the assurance handbook, going in sync with what was mentioned earlier, this just happened the other day. We've already starting to get a number of calls from accountants asking what the heck has happened. You'll see 2 listings now, which we don't have on the slide because it's changed since these slides were made, and this isn't a live presentation of Knotia. You'll see under assurance, when you hit the plus sign beside assurance, there's now 4 segments: Handbook Post-Auditor Reporting, which is the new standard; Handbook Pre-Auditor Reporting, which is the old; Highlight Summaries; and Basis for Conclusion. So I just mentioned that in passing so you're aware of what's going on in terms of that matter. The handbook again. Get your typical view. You'll see a note window on the right with details of the latest release as well, which is something that is very handy. So if you're not sure what's happened with the handbook, when you first open the file on the right half of the screen, you'll always see the latest update. You'll find that the most updates more often are for IFRS, but don't forget there are things that happen. I know folks sometimes rely on the print. There are annual soft cover books that you can purchase, but they are only issued once a year, so we always caution people to be cognizant of using the online. Again, don't forget, when you're in Knotia, it's no different than a lot of other things on the internet. If you hit the plus sign in front of, say, for instance, accounting or assurance, you get this view, which gives you the breakout of the various sections. Also, of course, you've got the public sector handbook in there. Again, there are periodic revisions, and this has certainly been occurring more often than before the last couple of years. And then what I want to spend just a quick moment on is the risk oversight and governance, which is 4 breakout modules. You've got an extensive 20-question series, a not-for-profit director series, you've got a CFO series, and the director briefings. And a lot of folks aren't even aware that this module is here, and it's got a rich segment of different things that are available. So you want to be able to pay attention to this. Here's another level of detail for these 4 sections. If you click on any one of the titles in any of these 4 modules, you'll get an icon at the beginning, a PDF icon, and it's a 4-color file which you can download for each of these files. We used to print them, but they got to be changing too often, so it wasn't practical or economical for us to continue, but certainly something that you can do your end. For a lot of you that are on directors of non-for-profits, for instance, or different organizations, these are excellent tools. And again, in brackets besides these tools, they'll tell you what the last update date was as well, which is very handy. Going on to something that's relatively new that people aren't as aware of, it's something called BAR, Business and Accounting Resources. This is a new database that contains CPA Canada non-authoritative guidance publications, including, and there's alerts, briefings, and other publications on a variety of subjects, and they cover a variety of modules in your practice. And also now we have online all of the issues of CPA Magazine since it was first rebooted, so that's available as well, which is very good to know about. Again, all of these things are searchable. So if you've had a situation where, like, I read something in an article on that, put in a search term and you can find it. That's the real beauty of Knotia. It's a particularly robust interface with lots of searching capacity. And then the BAR tool you'll see is here. It's located in Knotia. It's probably listed first because it's alphabetical. Going on a little bit, I just want to give you a bit more detail on this BAR info base. It has alerts, briefings, innovation in management, performance in management, risk in management, sustainability in management, and viewpoints. So it's very extensive. One of the latest entries that have been done, and I want to just take a moment about this, it's the new CSRE Standard 2400, which deals with the new review engagement guidelines. It is going to come into force, of course, December 14th of this year, but we just posted this in BAR at no charge. The Guide to Review Engagements was a very extensive paper that deals with this. This has been up, I think, for a month or two, and that's in the briefing section. And if you look under alerts, you'll find 2 or 3 other related documents. If you want to be able to target these, simply do a search, which I'll show you a bit more in a moment, and use 2400 in BAR, and you'll find all the documents on it. Also, as a sidebar, for those of you that have active subscriptions to the CPEM, Canadian Professional Engagement Manual, Under the Practice Aids module, Sample Engagement Forms, you'll see all of the new review engagement forms are posted. That's over 40 different documents. For those of you who have PPM, Professional Practice Manual subscriptions, you'll find that under the tab called Review and in the subsection called CSRE 2400. There'll be a new Professional Engagement Guide released in August, which will replace both the CPM and the PPM. If you have either of the archived products at the moment, CPM or PPM, your subscription automatically will be segued into the new product. If you didn't renew your PPM subscription, if some of you have that, on or before May the 25th, it's now canceled because on the 26th we included gratis all of the new review engagement documents. So if you want to have access to those, I'd suggest you get your PPM reinstated, and again, in both those documents will slide over to the new one. In the new PEG product, which will be released the latter part of August, Professional Engagement Guide, they'll also include a section called Practitioner Advice. It'll have all of the separate modules, some of the products that are only now in PPM. Now, besides the normal stuff that you'd expect, just a couple quick notes on content of the new PEG product. It will have both PDF and fillable Word files of all the forms and checklists, so you won't have to purchase any more if you're a CPM subscriber, the CPM templates. And also there'll be a PDF-only, read-only version of both the model financial statements for private enterprises and the private sector non-for-profit organizations. It won't be fillable. It won't include the book, so you'll have to separately purchase those if you do now. One last note on all of these changes with the PEG. If you are presently using a third-party fillable version of forms or checklists, for instance, from Caseware or CCH Engagement or Jazzit or Keystone Templates, you'll still have the prerequisite of having to purchase a PEG subscription or presently CPM or PPM before you'll be able to be accepted to get a license with them. Okay? It's a few moments of my time today, but I wanted to just highlight that. CPA Magazine, we'll go on to the next screen where it talks about, you'll see some of the breakouts of the articles. And again, it's completely searchable, individual issues from the very beginning. A quick highlight on how to do the navigation within Knotia. Again, I won't try to do an extensive how-to in this regard, but there are a number of things that we have changed. There's a new sleek, modern design. You've seen it's got sort of the blue and white and green. There's some new features that we have. One is called My Notes, which is kind of like adding an electronic Post-it note right in the info base, and we've now got the ability to retain those. There's also something called Highlighter, where you can actually simply, like you were in a print product, and highlight it with a colored pencil or something, and it will retain those. There's something called Pinboard, where you can highlight a document, and like on a little literal pinboard you have maybe in your office, if you're old school like I am and you still like a bit of paper. And there's something called EY Notes, and that's simply for if you've got tax products, so we won't get into that. A couple other items I just want to talk about here in terms of the new tools that we've added, My Notes and highlighters. You'll see that there is something called Briefcase, so that once you've done that, you'll see there's icons on these things up on the toolbar. And again, consult the help videos to be able to do that a little more effectively. One thing that maybe you find exciting as accountants, hold back your excitement, everybody, but there's now 4-color now in Knotia, so that you can use different color highlights and get a little creative. So we're getting there, guys and gals. Slowly, but we're getting there. My Notes and highlighters, again, talk about moving that over into Briefcase. So once you've made a highlight or a note, you can retain and find where you've put those by going over to the Briefcase tab and going down to the specific roll down on My Notes and highlighters. Again, the pinboard, if you decide to do a pinboard on something, you go up to this icon, and then what happens afterwards, you'll see it on the side of your screen. So that now the pinboard is over here on this side, and you can delete that. It might be that you're in the middle of a research project and you want to come back to it. Just simply do that now, and then later on, if you've done that research, you can delete it if you want. So you've got that ability as well. So basically, you have three ways of using the Knotia website in any individual info basis. You can use it like a book. So you just basically scroll through the table of contents on the left side, and you just open the plus signs. The more effective way, of course, is if you know where you're going. At the top of the screen, there's two squares. On the right side is something called Fetch. So if you know where you're going, you can just put in the section of the Handbook or CPA or Income Tax Act, wherever you're going. If you're not sure what that number is, you click on the little arrow beside that Fetch box, and it will give you all the choices depending on the info base you're in. Or you can go on the left side at the top of the toolbar, and you can pick a topic. It can be one word, it can be a phrase in quotes. You've got those choices. And I'll give you a little slide which illustrates a little bit more effectively how that can be done. Here's now when you're in Knotia, the top line in the toolbar are all your choices for searching. And whether it's search tools or shortcuts, and that includes a template icon. So all of that first line is to deal with searching. The second line in Knotia under the toolbar deals with a little more specific document. So first of all, you can copy a document, you can save a document, you can email a document, you can tag a document. That's in the first part of that second line. And then on the second part, there's a section that's called My Toolkit, and that's where you're able to save it to your briefcase. And again, the briefcase actually becomes a complete separate info base. For those of you in public practice, I'd like to suggest you keep in mind four key products. I call them the four legs on the stool. Obviously, the Handbook. If you do want the paperback softcover books as a member, you can get those for $175 a year to supplement the online. Obviously, the CPEM or the PPM, which will now be migrating, as I mentioned earlier, to the new PEG product. The Quality Assurance Manual, pretty much essential if you're in public practice. And then finally, the one that we've just added that we really are recommending that folks consider seriously is the Tax Risk Management Guide. It replaces the former product Tax Practice Manual, but this one is very much heavily emphasizing risk, and that's why it's in the title. It ties in closely with the new Tax Risk Questionnaire, which is free on the CPA member website. You can get that as a member or non-member. And if you're in a company environment, obviously there's other things that would apply, but those are the four that I certainly recommend and people keep in mind. And finally, a couple other quick points in terms of products. A few things that we've just moved into the Knotia environment. A client development newsletter called Business Matters is now available through the Knotia platform. And we've got two very practical series of Word files. One is called Professional Services Checklist Collection, and the other one is the Model Agreements, Resolutions, and Contracts. And for any of you that are involved in real estate or property management, we have 3 or 4 products in the RealPack family that are available as well. I won't belabor the point, but we certainly have some products in the area of tax. If you wish to peruse any of them or would like to have them on trial, please feel free to do so. And obviously, at the same time, we try to cater to every area of public practice, so not everything expensive. Some things start at $100 books, so we try to cater to all of those markets. So finally, thank you for this opportunity. Contact me directly if you have any concerns or questions. Either myself or one of my 2 sales representative colleagues, Tuck Harada or Nabil Hasbin, will be happy to help you. All the best with your upcoming corporate year-end deadlines, and I know you've got your one for the sole proprietor around the corner here. I hope you have a terrific summer. It's been my pleasure talking with you today. Please feel free to contact me directly if you have any questions or concerns. That's what myself and my 2 colleagues do. We try to minimize your frustrations and increase your research time productivity. That's our goal. Any particular questions, I'd be certainly happy to answer them, and thank you for the opportunity.
Thanks, Paul. That was a fantastic demo of Knotia. So we've arrived at the Q&A portion of our session. Should you have any questions, please submit them using the Ask a Question panel at the right of your screen. It looks like we've already got a few questions. So the first question is for Ismail. Ishmael, why were key audit matters not approved for listed entities like they were in the international standards?
All right, that's a very good question. So, like you said, key audit matters is actually a requirement and a significant component of the auditor reporting in the ISAs. However, when the AASB was communicating with the Canadian stakeholders, it was determined that changes to auditor reporting standards needed to recognize that the Canadian and U.S. capital markets are closely integrated. They emphasized that if key audit matter reporting requirements are significantly different between Canada and the U.S., this could really create some confusion in the marketplace and potentially affect comparability of information across the North American capital markets. Now, at the time these standards were finalized, the U.S. Public Company Accounting Oversight Board, or the PCAOB, had not finalized its auditor reporting standards. So as a result, the AASB believed that it was not appropriate to mandate key audit matter reporting for listed entities in Canada. So that's why it currently stands in the final CASs as adopted. They do not contain a key audit matter reporting requirement. However, they do allow for law or regulation to require reporting of key audit matters, and if the auditor wishes to do so. I guess a more recent update is that on June 1st, the PCAOB did approve their auditor reporting standards, including their critical audit matters, which is the equivalent of your key audit matters in the ISAs. So I believe the ASPE are meeting next week and will likely discuss the future expansion of the key audit matters reporting to other entities given this news from the PCAOB. I hope that answers the question.
Great. Thanks, Ishmael.
No problem.
Alpa, question for you. For the Redeemable Preferred Shares project, I noticed that some transactions that currently qualify for classification exception will not in the future. Has the board discussed whether these amendments will apply prospectively or retrospectively, and what will the effective date for the new guidance be?
Another great question, Mike. So the new guidance, from my understanding, will be retrospective, and I believe that will be posted in the latest decision summary from the May meeting, which should go up on the website shortly. The board hasn't discussed the effective date, I believe, as of yet, but it is on the agenda for their June meeting, and which I also believe the agenda is going to go up shortly on the website as well.
Great. Thanks, Alpa. Hugh, we have a question, a tax question. Let me see here. So, can you clarify when common law relationship ends for tax purposes?
That becomes a fairly confusing answer trying to parse through the legislation, and as we said, it's problematic because we don't control it. The legislation provides that once we're living in a common law relationship, so cohabiting in a conjugal relationship, we don't cease to be married for income tax purposes until we have ceased to cohabit in a conjugal relationship for a period of at least 90 days. However, once we meet that 90 days, essentially we ceased to be married from the start, not the end of that period. So maybe an example illustrates that. If I've got a couple who are living common law and one party moves out, the relationship ceases on January 15, 2017. 90 days after that date is April 15, 2017. If they reconcile, recommence cohabitation before April 15th, they simply remain common law, so married for tax purposes throughout. But on April 15th, now that they have been separated for 90 days, retroactive to January 15, 2017, they're no longer married. So there's no window of opportunity for still married while separated with a common law couple.
Thanks, Hugh. Paul, we have a question for you. Later in August, will the PEG be complimentary online like CPA Magazine and the CPA Standards and Guidance Handbook?
The answer to that is no. The only thing that you get free at the time and will continue are the three products I mentioned, the Handbook, the BAR, and the CPA Magazine. like the present paid subscriptions for CPEM or the PPM, when both of these products move into this new succession product, PEG, you'll have to pay for it. The price, I believe, for the new product is going to be $355 a year, and will include all of the core concepts, practical guidance, all of the forms, checklists, letters, in both fillable Word and PDF, and you'll also have those two bonus files, model financial statements, both private enterprise and private sector non-for-profit organizations. So if you don't have a subscription now, you should probably sign up now so you get the access to the new review engagement rules and all of the 40-some documents, and this will segue you right into the new PEG product when it's available.
Great. Thanks, Paul. So I'm not seeing any additional questions at this time. So I'd like to again thank today's speakers. The next webinar will be held in October. I think it's October 12th for English and October 14th for French. Please check the resources section for access to the PowerPoint slides, our webinar evaluation, and related CPA Canada offerings. And remember that in order to qualify for your statement of completion of CPD, you must pass the quiz. The quiz will be available following the webinar by selecting the quiz icon at the bottom of the page. After passing the quiz, select the certification icon to receive your statement of completion. You will be able to access and complete the quiz within the archived version of this event. Thank you all very much for participating in today's webinar, and have a great afternoon.